It's Bill Fairman and Jonathan Davis. Wendy is not going to be joining us today. We're all sad.
Yeah,
It's
contain your
nothing wrong.
sadness.
She'll be fine. Um, as an investor, passively in a fund, have you ever wondered if you could take advantage of some of the tax deductions and things that most property owners can take advantage of?
Things and details
And
coming up.
yeah, right after this. I'm sorry, we meant to say stuff
Stuff
and
instead of
details,
things. Yeah.
not things.
Uh,
Welcome to the Passive Wealth Show. Once again, I am Bill Fairman. This is Jonathan Davis. We are Carolina Capital Management. We are lenders in the Southeast. We make loans to real estate investors. So if you're a borrower interested in borrowing money, go to our website, carolinahardmoney.com. Click on the Apply Now tab. If you're an investor looking for passive returns, then click on the Accredited Investor tab. Don't forget to share, like, subscribe, hit the bell. Uh, also, we do have a comment section for questions if you have any. It's either on the right hand side of your screen or below, depending on the platform you're viewing us from. Put in a question. If we have an answer, we'll answer it. If we don't, we'll tell you we'll get back with you or find someone who does.
we'll conveniently skip over it and not see it. Huh.
We have some interesting real estate news locally that we'd like to discuss. So let's get to the breaking news. Okay, and we're back. All right, so I'm going to cover really quickly the employment numbers that we've been covering every week since the pandemic. So last week's numbers that were initial claims of 683,000
Hmm.
was the lowest since COVID.
Which is great. Which couples with Friday's job reports will be the highest that it's been in in like
Oh, wow.
8 months, 9 months.
So if you go back uh, this week, uh, a year ago,
Hmm.
initial jobless claims were over 6 million. And this week it was 719,000. So it's drifted up a little bit from last week, but still, if
Still
you want to compare the
perspective.
two,
Yeah.
it's the economy has come back
Well, I
quite
mean,
a bit.
and you can couple with, hospitality is starting to add more
Yep.
jobs because they're allowed to be opened up more with more vaccine people taking vaccines and stuff like that.
Speaking of vaccines, I've been waiting for the Johnson and Johnson shot because I only want to
Well,
do
they're
it
on back
once,
order now.
and now they had a problem with their manufacturing, and they took 20 million doses off the market.
Yeah, yeah,
so,
they're on.
so apparently my wait's going to be a little bit longer. Fortunately, I still have antibodies, so I got time. Uh, if you guys are wondering why and I just posted this in our uh, Facebook page, Carolina Capital Management Facebook page, about 30 minutes ago. It's a great article by Roof Stock, and I'm looking to really see where the market is, especially in the Charlotte area, since that's where we're based.
Hmm.
And I was wondering about inventory. Well, from the Charlotte Observer, we have what equates to 18-day supply of existing homes.
So that's
18 days.
pretty low.
They posted a picture in there of a line of 25 people
Uh huh.
waiting to get into an open house on this past Sunday.
Yeah. Hmm.
The median sales price in Charlotte has gone up 11.7% from last year.
Isn't it's a lot of appreciation, isn't it?
Man. So these are the type of markets that if you make a bunch of mistakes, the market is going to reward you anyway.
Oh yeah, oh yeah. Because we were I have a project that I've made several mistakes on, And luckily, we're in this market. I can make those mistakes.
Yeah, if you're going to do this and you're kind of new and you're going to earn while you learn, you're definitely going to be on the earning side more than I'm paying to learn.
Yeah. Yeah.
Because it's hard to go wrong in this market just because again, 18-day supply.
18-day supply, 11%
stable,
appreciation.
A stable market is 6 months, not
18 days.
And that's just unbelievable. Now, speaking of mistakes that you made, and I'm not going to talk about the mistakes. I'm just going to talk about the area you made them in.
My mistakes?
No, the house you work.
Oh, yeah, the area,
Concord, which is for those who don't know, is a suburb of Charlotte.
It's where the Charlotte Speedway is.
Yeah, Charlotte Motor Speedway and their drag strip, and they have completed a major part of the interstate going north, and so that whole northern corridor has really opened up. And so Concord, city of Concord, has got the 20th fastest growing economy in the country right now.
I knew that was going to happen, and that's why I bought that house in Concord.
Yes.
Yeah.
I'm sure. But if you get a chance, like I said, I posted that article on our Facebook page. It's Carolina Capital Management Facebook page. It goes into a lot of detail on why Charlotte is a great market for investors as well as people that are moving here. People are already moving here prior to COVID, and even more people are moving here because you can work remotely. Charlotte has a great diversity in employment. Charlotte is the second largest financial
hub
behind New York City, but we also have really good high-tech jobs as well as distribution. And I've said this before, Charlotte is within 1 day's truck drive of nearly 50% of the U.S. population.
The entire Eastern Seaboard. Yeah.
So logistics is, and that's part of the reason why Concord is getting so popular. They have a lot of warehouses going up.
Oh yeah, there's a lot more land out that way. Yeah,
that's right. And we have a very good north, south, east, west interstate system here too. So,
yeah. Yep. 77, 85.
So what are you seeing from some of our customers on trying to find inventory?
They're trying to find inventory. I think right now I'm seeing more an uptick in new construction, which, naturally, when you don't have inventory to take down. I mean, the off market, I guess, deals. I think everyone thinks that they're down. I don't think that they're down. I think targeting them has to change. And there's some really good guys in Collective Genius who have talked about that. And what's one of their names?
Well, actually, Michael Moulton is right here in town. He's up in.
Oh yeah, Mike Moulton. He's in Kannapolis.
I don't think he's up in Kannapolis. Anyway, he's in the northern part of town.
He's the guy he was getting Spectrum.
Yeah.
He's in Kannapolis.
Is he in Kannapolis? Okay.
Yeah, he's in Kannapolis.
Yeah, we were talking about this because his house was so far off the road that he had to pay gobs of money just to get him to put cable down to his house, and he decided instead of them do it, he would just do it himself.
Yeah.
And then they would connect him.
Yeah. But
now he's got high-speed internet.
And it all works out.
And TV.
Yeah. So, new construction's on the rise, even with the higher. So it costs more to get into a lot. Lot prices have surged, and it costs more to build. So, because, not just, we all talk about lumber, but everything across the board. Even the handles, like cabinet handles and drawer handles, like a package of handles that you used to buy for $19 and now $24.
It's commodities,
yeah.
And we're running into an issue where there is real inflation, and I'm going to cover that soon. While I say that, while I'm on the subject, if you're investing, you have to keep an eye on inflation. And if you're not investing in real estate, I don't see any way that you're going to keep up with real inflation. You're going to get appreciation in real estate.
And what you mean by real inflation is not just the Fed reported monetary inflation. You're talking about inflation of everything, like the cost to live.
Yeah, they take out food
Mhm.
and energy right off the top. They don't even count that.
But we all know that food prices go up.
Yep.
So do
and energy
resources.
And their reasoning behind it is because it's too volatile. Well, you still should include it. Over time, those things will. If it is volatile, that's fine. But over time, you still get those numbers.
Yeah.
They don't want to include it because they don't want to raise the Social Security checks.
That's exactly. Yeah.
That said, there is a school of thought that because our monetary system is still a little strained.
Oh, I thought you were going to say antiquated.
Well, no, they're not. If they aren't lending money like they should be,
okay,
because you have regulations on the big banks, they're still going to have reserve requirements that they have to maintain. Well, they're easing up on them a little bit. The more restrictions that the banks have, the less money that they can lend. And so the thought is that, inflation will stay kind of in check. I don't believe it. I'm not one of those.
Well, I want to pivot off inflation because you brought up banks and like it's a sore subject for me. We were talking just the other day about that fund that blew up over the weekend?
Yeah. Arcos, something like that.
And they were levered. What did you say they were levered?
5 to 1.
5 to 1. So every dollar that they had $5 lent to them.
Yes.
Yeah. So.
By the way, they still haven't. None of the big banks that gave them that leverage have still come out to say how much they could lose.
They could, yeah.
They haven't calculated. It's taken them this long. They still haven't calculated.
Well, why would they do that? Because they just had to close out Q1. They don't want that to affect their Q1 numbers. Like everyone starts selling.
Well, part of that is they probably don't know yet because they haven't sold off all the assets.
Well, that could be another piece of it. There are estimations. But I guess so this guy, didn't you say the fund, wasn't he convicted through the SEC of
insider trading?
Insider trading, which is a felony, right?
As far as I know.
As far as you know, so it's a felony. So we have a felon getting 5 to 1 leverage on his fund. So the part that bothers
Martha
me.
Stewart went to prison for insider trading. Actually, no, she didn't. She was questioned about insider trading, and then she lied to the FBI about not trading insider information.
Gotcha. Well, just because Martha Stewart does it doesn't mean he should. But what bothers me is, so this was several months back, more into the COVID, pandemic where it was more fresh. I tried to get one of my properties refinanced with a local bank, and there was a tenant in there, cash flowing, almost a 1.5 debt service coverage ratio. I had actually more cash with that bank than the loan amount that I requested.
Yeah.
So I was giving them a first lien on a property with a tenant who was paying, and I couldn't get that loan. I couldn't get it.
Well,
but a convicted felon of insider trading can get billions of dollars in leverage with our banks who get bailed out when they make bad choices.
That's because you're not a well-known fund manager who knows people on the inside.
I'm kind of well known. We have like 20 followers.
At least 25.
Yeah.
So that concludes our news of the day. Well, let's get over and talk about our ugly question.
Okay.
Well, frankly, today's question isn't really that ugly. Uh, it is a question from an investor. If I'm an accredited investor, is pass through depreciation possible? Uh, that all depends on whether the fund has depreciation in it or not.
Or even if it's a fund. I mean, or I guess it could be. It could just be an LLC partnership that's passing through.
Yeah,
No.
we're all going to start off with this same attorney answer. It depends. It depends on how the fund is structured. But in most cases, private placement funds are owned. They're LLCs that are owned by the investors.
Correct.
Okay.
Yep.
So if the LLC is buying property, and if you're in the real estate side of things, and essentially you're buying property for the income, and then, and again, there's different types of funds. Some funds are going to buy existing cash flowing properties that don't need improvements.
Some are going to build.
And then some are going to do development, and
Mhm.
then some are going to do value add.
Mm-hmm.
So when you're in a development and when you're in value add, there is going to be a lot of depreciation. Of course, we were talking about the accelerated. What's that called?
Yeah. A cost segregation is a way for funds or even individuals to accelerate the depreciation of a property by having a study done saying like, hey, this needs to be replaced every 5 years, or this needs to be replaced every 10 years, and not what is it, like 35 years is what they normally do it at.
Something like that.
Yeah.
So that's all that said. Yes, you can participate in the depreciation. Here's a caveat though. If you're in a fund and this is the only money you're getting from the fund, if you're only participating in one fund
mm-hmm.
that you're getting depreciation on, it's not going to offset the income you make actively. So let's say
you mean actively outside of the fund, or actively in the fund?
So if you're let's just say you're a dentist and you have a practice and you're getting taxed on your active income,
mm-hmm.
the passive depreciation that you're getting on your passive investment isn't going to offset any of the
well, those are two separate. Those are two separate buckets.
And so what I'm saying is that if you have, say, for example, you have money in our fund, which is income and growth, but it is got no depreciation. There are no tax benefits to being in our fund. It's just strictly income. It's still passive income.
Yeah.
You could use the depreciation from the property owning fund to offset the gain or the tax on the income from our fund.
Mm-hmm.
But if at some point you're in one of those funds where, let's say it's a syndication, you have one property in there.
Yeah.
And you're getting this depreciation along the way, it's not offsetting anything other than income that you would be receiving from the property as it's being developed.
Exactly. The IRS sees active income and passive income, same thing as depreciation, as two separate items.
Now, again, I'm not a tax expert, and I don't claim to be.
Nor am I.
Talk to your CPA. There may be a way to use some of the depreciation to offset some of your capital gain, which it looks like with the current administration, there's going to be a lot of capital gains going on.
Yeah. One strategy might be, not on the depreciation side, but on the active side, if you want to offset active income, you just need to pass the test of being an active real estate investor for the IRS. Talk to your CPA about what that is, and it allows you to offset active income with income through the properties, because now you're an active real estate investor, and now that income gets to be, or that depreciation or losses get to offset the active income.
I don't want to bring this up because this is for another show, but the way the new administration is thinking about taxing, I started thinking about this too, especially with the inflation. Um, you're going to try to avoid a capital gain whenever possible. So I'm thinking a lot of the funds may be rethinking their strategy of selling when a project is complete and refinancing it, cashing out, and then holding it for income. Because if you're an investor in a syndication and it sells, that's all capital gains to the investor.
Yeah.
If you cash out and it's, you refinance it, you cash them out, then that's a cash out refinance and that's not taxable.
Yeah. And isn't, and I don't know the answer to this. The new administration, aren't they against 1031 exchanges?
They're against anything that they can't get money from.
Yeah. So 1031 exchanges would be in that bucket.
Right.
So then you can't shelter those capital gains through a 1031 exchange into a new property. So the strategy that you just said is probably about the only way you could shelter anything.
But I can tell you this: no matter what they do, there will be loopholes that somebody will figure out. And what really is a shame is that they try to complicate things so much. The easiest thing to do is be to just keep the tax rates the way they are, and then just don't allow deductions. Just everybody pays whatever percentage, and that's it.
Oh,
They
come
would
on
raise
now.
so much money.
Come on now.
Just saying.
Everybody likes their deductions.
Well, of course they do, but wouldn't you rather just pay a lower rate?
Pay a lower rate and have no deductions,
Yes.
or pay a higher rate and have deductions. I don't
Now,
know.
you still have expenses. They're not deductions. They're just expenses that don't count in profit.
Mm-hmm.
So those are still not taxable, the expenses.
Yeah. Interesting. I will talk to my CPA about that.
No, you need to talk to your congressman.
Well,
because your CPA can just advise you.
well,
They don't make the law. They don't make the policy.
But they find the best ways to work around the law.
Well, that's true.
Yeah.
But they do have a good lobby, and that's
to work with the law, not around it. I'm sorry.
That's why there's not a flat tax. It's because the CPA lobby, financial services lobby.
That's right.
All right. I hope that answered your question. One of the ways you can offset taxes and fight inflation is to be in a fund that allows you to compound your returns over time. Because if you're just getting your standard return, whatever it is, whatever fund you're in, that's going to be at a certain level. But if you're allowed and you're in a position to grow versus you need the money right away,
yeah.
My suggestion is to always compound it and let it grow, because now you're definitely going to beat inflation if you're compounding your returns over time.
Yeah, I mean, what if someone created a Roth IRA, started a self-directed Roth IRA, started loading money into it, took that money and invested into a fund like ours that allows you to compound interest. So now you've already paid the tax on the front end. You're compounding interest. That's a pretty sweet deal, isn't it?
Yeah, you can do the same thing with a life insurance policy that you can borrow against it, and the money that's inside of the life insurance policy is non-taxable, but the money that you make in the fund would be taxable. But it's a good way to offset at least half of your return tax-wise. All right, we're getting down here to the bottom of the hour. I don't want to forget Wednesday with Wendy. That Wendy gives people 30 minutes of her time, talk about anything real estate. There's the link. Our next show is with Javier Hinojo. He is a real estate investor in the Raleigh-Durham area, and he's got quite a story to tell. So don't forget about our next show. We also are participating in the Quest Expo that is coming up at the end of April. I think we have a link there as well. There's a code where you can get 50% off, I think, for the tickets. Thanks again for joining us. This is the Passive Wealth Show. I am Bill Fairman, and that is Jonathan Davis. We are Carolina Capital Management. We are a lender in the Southeast. If you're a borrower interested in borrowing money, CarolinaHardMoney.com. Click on the Apply Now tab. And if you're an investor looking for passive returns, click on the Accredited Investor tab. Again, don't forget to subscribe, share, like, hit the bell. We'll see you on the next show, which starts momentarily. See you later.